Hello everyone, this is Amit Sajeja, Vice President Research belonging to the Currencies and Commodities Research Team at Motilal Oswal. Recently, we have seen that two key measures of volatility for USDINR pair, that is the moving standard deviation and the average true range, have been steadily breaking out of their consolidation phase. This video is aimed at discussing the implication of this rise in historical volatility on both futures as well as options price. Looking at the weekly chart of spot INR, we have found that since the last 7 months, that is since October 2022, the price of USDINR has been steadily moving in a very narrow band, tracking broadly between 83 and 81 levels. As can be seen, it's been moving up and down alternatively since the last several months now. Even now, we haven't got a clear-cut breakout. However, two prominent measures of volatility which we just discussed, that is a moving standard deviation along with the average true range, which broadly give a gauge of how much intraday or intra-week or intra-month volatility we can have in the underlying, that is in this case spot INR. They have been steadily showing some signs of moving out of their range. Till now, if you look at the weekly chart, both these measures have been hovering very close to April 2021 lows, which is broadly a 2-year low. However, looking at the daily chart currently, we can see that one of the measures, that is the moving standard deviation, has been breaking out of its steady downward sloping trend line and moving higher. So this implies that historical volatility has been breaking out of its consolidation phase. So let us understand the implications of this rise in historical volatility on options and futures pricing. The first prominent bearing which historical volatility has on implied volatility is that option prices generally tend to move higher when implied volatility rises. Also, this is important from the point of view of option writers and option buyers, because generally when option pricing is at lower levels because of lower implied volatility, it is better off to buy options rather than sell options. Secondly, implied volatility has a general skew to the right, which means that the rate of change in call premium when the market is rising is higher as compared to the rate of change in the price of puts when the market is falling, in this case the USD-INR pair. Thirdly, also the average intraday, intra-week and intra-month volatility for the USD-INR pair, in this case the average range, generally tends to rise when volatility rises. So currently if you observe, just about a week back or a couple of weeks back, we were looking at an average intraday range of about 8 paisa to 12 paisa in USD-INR, but that average range has now risen to about 15 to 20 paise. Similarly, from an intra-week perspective, that is week-on-week basis, we are looking that the range has shifted from an average of about 28 to 30 paise to about 45 to 50 paise currently. So these are the broad indications which we can derive when historical volatility rises. For more such updates, search Motilal Oswal.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.